Hello, everyone. Today on the Final Bar, I'm talking with Chris Vermeulen from the Technical Traders. We will try to make sense of the last 24 hours of market activity, maybe 27 hours if you go back to before the Fed meeting yesterday. A lot of movement, and I read years ago Jesse Livermore's quote: "There's time to go long, time to go short, and time to go fishing." If you have the opportunity to sort of relax and let this sort of week play out, good opportunity to do so. We'll talk about what today's distribution means relative to the long term. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we debrief on the market activity using the power of technical analysis, using the StockCharts platform to better understand investor behavior, try to make sense of these uncertain markets and uncertain times. There's been a ton of volatility, as I'm sure you're aware, if you're a market participant. Today, obviously, quite a bit of distribution in the markets, giving back all of yesterday's gains and more. And I don't want to say this is kind of what we've been talking about. This is kind of what we've been talking about, right? Sort of the bear market rally movements can be incredibly sudden, incredibly severe, and incredibly seductive. And you certainly saw that yesterday. The big rally out of the Powell press conference. We'll talk a little bit about that in a few moments when we get to the market recap, what these movements in these different asset classes really mean and what's really changed in the last 2 days. My argument would be not a whole lot. I think we're right back where we started in this distribution phase for risk assets. Now, we have great guests on the show. Chris Vermeulen is a fantastic guest we've had on before. Really excited to get his take on what we're seeing right now. Coming up next week, 3 good guests for you. On Tuesday, the 10th, we have Larry Berman, the founder of ETF Capital Management in Toronto. On Wednesday, the 11th, John Gagliardi. He's a strategist at Fidelity Investments. And then finally, Thursday, the 12th, Matt Maley, who's Miller Tayback and founder of the Maley Report, giving us some perspective as well. Also, as a reminder, we have so much great content coming every trading day. StockChartsTV.com is our on-demand platform, some of our recent special events, and also market takes from people like Larry Williams and others that I'd suggest you review. Let's get on to today's market recap. We have a lot to talk about. I'll pack as much as I can into our short window of time together, but I would encourage you, as always, to start with the dashboard on StockCharts and look around at some of these different ways to slice and dice the performance of the markets today. I was talking to someone earlier today. It's kind of a funny story. I was getting my car serviced at the dealership nearby. I heard someone talking about the markets, which is a great anecdotal piece of evidence. And his voice was getting more and more nervous as he's watching technology stocks rotate lower. And he was lamenting about the performance of NVIDIA. And I explained to him what these last, what yesterday's rally really meant. And the analogy I shared with him was this. Let's say you're a younger brother, you're a younger sibling, you have an older sibling, an older brother who's slapping you in the face, as older siblings have tended to do. And then at one point he says, you know what, I was going to slap you even harder next week, but I decided on the other hand, I'm probably not going to. I'll just keep slapping you the normal way. And your initial reaction is awesome. It's not going to be worse. But then at the end of the day, you sort of look back and you're like, well, I'm still getting slapped, though, and that's not particularly comfortable. And I feel like that's what the market has done in the last 2 days. Yesterday's big rally was because a 75 basis point hike was taken off the table. What is still on the table still tells you about the specter of inflationary pressures, the challenges of inflation, and what that means for consumers, and just the distribution that you see, particularly in the growth areas of the market. None of that really changed yesterday. It was just the language to try to make these future changes feel a little more palatable. And as probably you could have hopefully guessed today, showing that distribution that we had seen up until the earlier part of this week as things sort of stabilized and waited for the news from the Fed. At the end of the day, it's a lot of what we've been talking about, those macro headwinds to growth stocks in particular. The NASDAQ was down about 6% earlier, almost 6%, and settled in up just a little bit, down 5%. Now, before you get too excited about, oh my gosh, that has to be the worst day in history, Thank you, Wikipedia, for having all that data readily available. We're not even close. On an absolute basis, you could probably say this is one of the worst point loss, and that's something that'll probably make a headline. It is so incredibly meaningless. What is meaningful is the percent movements, right? Because that more normalizes with the data. And this isn't even close. I mean, big down days, the top 20 days or over 6% down. Now, granted, this was a painful day. I don't want to minimize the pain that you felt if you're long, growth stocks today. But it's worth noting that the market certainly can move lower in distribution phase. When you look at when these days are, a lot of those are sort of in the early to mid 2000s. They're in 2008, 2009, 1987. These are the days that are in the top 20 worst performers. Not a lot in relatively recent history. The last ones would be in the March 2020 period. And that brings us to some of the challenges we're going to look at when we look at the individual stocks. However, let's just wrap up on what happened today. The S&P down 3.5%, below 4150 into the close, and NASDAQ 100 down as well. The VIX back above 30. And we talk about that VIX moving above 30, how that really represents an excessive volatility environment if you look at the last 6 months, and that's sort of been the upper bound of it. But remember that the VIX is not absolutely bound, meaning it could go to 40 or 50, even up to 80, as we saw in early 2000. Not that I think that's necessarily a likely scenario, but it's possible. So, you have to be careful thinking of, the VIX hits this extreme high level and I buy, and it's pretty easy. Volatility can go higher and can remain elevated. Speaking of going higher and remaining elevated, let's look at interest rates. 10-year yields going above 3%. 30-year yields actually going above 3.1%, making new highs. The peak in the 10-year yield going back to 2018, around 3.25%. So we're getting closer and closer to that, but still a little ways away from where we're at today. The dollar index rebounding after coming off yesterday, bouncing back to the upside with the UUP up 0.8%. Commodities relatively calm compared to the rest of the world, which was super volatile. The DBC down about 0.5%, gold down a little, silver down over 2%, but some of the energy-related commodities up okay. Cryptocurrencies really showing that distribution. And more on these days when I see a lot of distribution, I'm seeing that reflected or even magnified in cryptos. And so I would argue these are very much risk assets. At times people have said, are they uncorrelated? And when the market gets uncomfortable, could we go to the relative safety of cryptocurrencies? I'm not feeling that on days like today. You're certainly seeing them, represent a sort of a proxy for speculative pressures. And it's certainly going to the downside. Bitcoin down about 9%, Ether down 7.5%. The top 10 coins all down fairly significantly today. Let's go to a chart of the S&P 500 to talk about how this market has evolved. So again, when you look at the day-to-day movements, it's very easy on a day like today to focus on all the red. And granted, that is the reality if you're looking at one day's movement. It might be helpful to just look at the 2-day returns and really think about how much things have changed from 2 days ago to where we're at right now. We're not too far off from where we were, 2 days ago. We're actually a little bit above where we were a week ago. So we've chopped around a bit, but haven't really made any directional move. And that is the nature of a market in turmoil, is you have a lot of uncertainty, which means elevated volatility. And in this case, the market's chopped around, but not really giving that directional change, right? Yesterday's bounce was impressive going into the close. We closed right at 4,300, but this was not a move with staying power. And unfortunately, bear market phases are often, often represented by some of these big up days. Just look at the last look year to date, and you'll find some of these big long up days that have happened, even though overall the longer term trend has been fairly negative. It's a good reminder to focus on the big picture evolution, to focus on how the themes have evolved. So where are we at? We're back below the 38.2% retracement level, which is around 4,200. That's using September 20 to January 22. That's a level of support we've talked about. It's that green shaded area has served as support before. We're now closing below it once again. And again, any bull market, any sort of recovery story would mean we close back above that resistance and stay there. And that's what we did not get yesterday into today. So again, making or threatening a new closing low for the year. Didn't quite undercut the close from a week ago, but getting very, very, very close to that. And so good time to be thinking about risk management, as we've been talking about for quite some time. I would stay diligent and focus on where you see opportunities to get defensive or raise cash as needed. Finally, looking at sector movements, then we'll take a quick break here. Utilities, energy, consumer staples at the top of the list. I was running some scans for my premium members at Market Misbehavior in areas that we found new swing highs. Not many, but a lot of it in consumer staples, to be honest with you. Charts like K and others. Hershey's are names that have had really good runs, but others, tobacco stocks, these are ones that are holding up pretty well and are actually showing some positive rotations in a lot of cases. Energy obviously has been fairly strong. You had a lot of earnings this week. Charts like MPC and others are actually doing pretty well around that earnings release. Utilities, the top performing sector. All 11 of the S&P sectors down, by the way. At the bottom of the list, it's the FANG sectors, or the FANG sectors, consumer discretionary, technology, communication services. That ratio of the XLY to the XLP is just such a great reminder of focusing on the big picture and how it's evolved. I just want to finish with that chart and then we'll be done here. This is on my Mindful Investor Live chart list, which I keep updated on StockCharts.com. This is the relative performance of consumer discretionary versus consumer staples, making a new 52-week low today. This is the equal weighted version of that ratio. So it sort of takes things like Amazon and Tesla, the overweight of those stocks out of it. It's just looking at all of those individual names between the two sectors. It's clearly been favoring consumer staples, the relative defense over offense, really since November of last year. Until those ratios turn higher, I would be skeptical of any sort of bounce you see in the markets. This tells you there's not a lot of staying power because investors are not really rotating away from defense and into offense. Let's take a quick break and we'll be back with today's guest, Chris Vermeulen. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. It's great to have you join us every weekday after the close for our show. We are here to help you try to navigate these markets in uncertain times. Chris Vermeulen is going to join us here in a few moments. Before we bring him on, I just want to remind you, we'll do a mailbag segment later in this week on Friday's show. We'd love to feature one of your questions live on the air. Best way to get your questions to us is via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Special events like The Pitch, our StockCharts Draft, which aired last week, Larry Williams' Market Outlook with a very bearish perspective a couple weeks ago to note, and also really knowledgeable guests like Chris Vermeulen and many others on demand at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Chris Vermeulen, joining us on the show once again. Chris is the CEO and Chief Market Strategist at thetechnicaltraders.com. Chris, it's great to see you. Thanks for joining us on a volatile day in the markets.
Yeah, thanks for having me, David. It's volatile for sure.
Right. So the last couple of days have been obviously pretty noisy. You're as good as anyone to help us really make sense of those long-term trends. We're starting with a look at the S&P 500 along with the proprietary indicator of yours. What are we looking at here?
Right. So the blue line there, that's the daily line chart of the SP 500. And it goes back to just about the beginning of 2020, just before the COVID crash there. And I want to put that on because the behind indicator is an indicator of the overall market momentum, the money flow of the overall stock market. And bottom line is when there's green, when you see the green above the black, that is a sign where there's strong upward momentum and money is flowing into growth stocks, hand over fist. That's when you want to be long equities. And you can see that green indicator does roll over just before the COVID crash. We started to see big money flow, momentum stalled out. Same thing happened in February of 2021. That is when pretty much almost all growth stocks just came into a sharp peak, right at the very top there. And a good example of that is the ARK ETF. But what's interesting here with that chart there is simply when that momentum stalls out, we don't have green on that back indicator, that becomes a very tough market for stock traders. Anyone holding stocks in their portfolio is naturally going to see their portfolio lose value, even though the stock market is going up. And that's why I've compared the two. There's a time when stock trading stocks is great. There's a time when you almost need to go more defensive, move to index trading, because the index gets carried by the heavyweights and provides lots of opportunity with low risk versus trying to get into these growth stocks that are under pressure. And so that's when you have to kind of flip strategies from, aggressive growth stock trading to maybe more of a passive kind of index trading strategy. So that's what I wanted to show there, is you do need to flip strategies as the market evolves and changes its stages.
Yeah, it's so important to stay nimble in this sort of environment the last couple of years. You mentioned the ARK Innovation Fund in particular. That's chart number 2. What's the take here?
Right. So the top chart is the ARK, and that's February 2021, right when growth stocks peaked out. And I just kind of wanted to show more or less the difference again there, that how growth stocks can just sell off in such a big way, down 65, 70%, where the stock index can actually be up positive against those overall growth stocks. So there's a huge divergence. And, this is where we saw after COVID hit, we saw everyone turn into a trader. We saw, the Robinhood take off, and all those traders were, it was a feeding frenzy for stocks. But once that momentum stalled out, all those short-term traders who don't understand the different stages of a market, this is why we've seen probably Robinhood cut 9% of their staff. They've got their business is crashing, because in the last year and a half, if you're buying and holding stocks, you're losing money. And I mean, people don't realize that even though the stock index is going up, it doesn't mean stocks in general are going up. It's the complete opposite. When we've got this divergence, it can lead us to a really bearish picture in the stock market, meaning maybe this upward momentum is done. Maybe we're coming into a whole new phase of the stock market, which could be more or less a bear market decline. And people haven't fully grasped that just yet. But I think there's going to be a wake-up call here soon where investors are going to realize, you know what? Maybe the stock market isn't going any higher. And so that's the big question right now.
Your third chart, it's a perfect segue into your third chart, which I'm hesitant to bring up because I think it tells a very good story about the cycle in investor sentiment. Where are we at right now and what's next?
Yeah, so you could argue that, that we've had that euphoric rally. As much as we had the COVID crash, everyone in the world piled into the stock market and started trading. And I feel like that's what that huge rally was going into late 2020 into early 2021. And then it peaked and everything has pretty much moved down other than the indexes. And now we're in this complacency stage where the stock market, really, you look at the SP 500, it's actually trading. It hasn't gone anywhere since April of 2021. I mean, it's gone nowhere in a year at this point. We're back down to those lows. And that is like the complacency stage. This market is trading sideways. It is threatening to break down. And this is where investors, they don't get protective with their money. To me, this is one of the most important parts for anyone who's 50 years or older. We could go into a bear market that could last 18 months. It could last 4 years. It could be like a 2000 top where we really never see new highs to our money for 12 or 18 years, depending if you're in the stock market or growth stocks versus the SP 500. And if you don't get protective and we do break down, this is the worst possible time to be holding stocks long-term. I would much rather miss out on some future gains than hold through what potentially could be a very nasty bear market going forward. And, the stock market risk on the top right of that chart, we're up in that red zone, the top red zone with peak maximum financial risk. I don't see a whole lot more upside in the stock market. I don't see a lot more upside in real estate. I don't see a lot more upside in businesses. I think the recession, people are tightening up with their money with inflation. There isn't a whole lot of upside. I would much rather step aside and wait for the market to break down and take advantage of a falling, collapsing economy, a stock market, and then prepare for a bull market whenever that happens in the future. So I don't think, dumping new investment capital in right now is a great decision. I think you need to be very defensive. It's not about making money. It's about preserving money right now. And if you're an active trader, there's a lot of money to be made on the collapse. But if you're a passive investor, there's nothing wrong with a cash position for a few months or a while the market free falls, because not a whole lot really goes up in value.
That's a great description of the value of risk management, and charts, as you and I know, often prepare you very well for that decision. Chris, it's awesome to see you. Thank you so much for coming on, sharing some charts with us and helping us make sense this week. Stay safe there, and we'll talk to you soon.
Thanks, David. Take care.
That's Chris Vermeulen. Chris is the founder CEO of the Technical Traders. Great take, and that last chart reminds me of a lot of the discussions we would have in my Fidelity days in the chart room. We had some charts talking about that, the cyclical nature of sentiment. If you look back through historical bubble phases, if you look at historical market crashes, while the specific catalysts and the way that those things evolved at times are different, the consistency is human behavior, right? The fact that people get euphoric, that people get desperate, there's excessive fear, excessive greed. That has been the story of the investment landscape for well before Chris and I and many of you have been investing. This is the nature of human behavior. Great take there from Chris Vermeulen from the technicaltraders.com. Let's continue on today's show. Getting sentimental. We like to do about once a week is check in on the sentiment indicators. It's an interesting time to do that today. And the reason is because the sentiment picture hasn't changed a ton from yesterday to today. A lot of the data is really based off of this market that's sort of chopping around. It'd be interesting if you did all of these sentiment gauges as of this moment. I'm wondering how quickly they would roll over because of this move that we saw today and how much that impacts people that are engaged in the market right now, for sure. What we'll do is look at a couple different pieces of this. We'll look at sentiment first using the VIX and talk about volatility. We'll look at some survey data, and then we'll finish off looking at put call ratios and then wrap the show. So first off, the VIX, right, the volatility index. VIX back above 30 today, had come down to just above 25 yesterday as the market moved to the upside going into the close today, giving a lot of that back. You know, the challenge I would tell you, as we've talked about, this chart can be really helpful for identifying short-term swings, right? And if you look every time over the last 6 months, the VIX has gone above 30. It's represented a short-term, very tradable bounce. Anytime the VIX has gone below 20, that has been a good tradable bounce to the upside. And so that's been pretty well a good range for the VIX. The problem is that range is not set in stone, right? Very quickly, we could go to a low volatility environment like we saw in mid-2021, and the whole range gets compressed. On the other hand, we could get an excessive volatility environment like we did in late 2020. The whole range starts to move higher. So the VIX moves in what I would call volatility regimes. There are periods where certain levels have meaning, but you have to make note of when things change. And I will tell you, one of the best ways I've learned to use the VIX is to look at when the range of the VIX, when a new volatility regime begins, right? Does the whole volatility come depressed? Does the whole volatility, become elevated? And as a result, those are the major turning points. Those are the changes in character of the market. So starting in November, the VIX started to go higher, reached a new swing high around 30. And from there, we've settled into this range. If we would get an acceleration to the downside, following through the distribution that we saw today, you could absolutely see the VIX go much higher, go to 40, 50, even more, depending on how quickly and the nature of the move to the downside. But I would certainly be expecting higher volatility. One of the interviews I gave the first week or two of the year was, you know, what's a prediction for, and I said that the VIX will get above 20 and spend way more time above 20 than below 20. I didn't realize it would be completely not below 20 for the entire year, which is what it's felt like so far. But we've certainly seen that nature, and that means elevated uncertainty. That means a lot of movements like we've seen in the last 2 sessions. So I would be bracing for that sort of movement. Second chart, we're looking at sentiment in the form of survey data. This is individual investors, the AAII survey. We'll look at money managers here in a moment. Bouncing up a little bit. The bullishness was fairly low last week. You had a record record high number of bears, coming off a little bit, but these are still fairly exaggerated levels of bearish sentiment. Bulls popping up a little bit to around 27% bullish, bears around 53%, which was down from around 60% yesterday, but still fairly high. As a result, the spread between the two is around 26% of bears outnumbering bulls, essentially on a 2-to-1 basis. And overall, that is at the lower end of the range that you've seen historically. Last week's reading was one of the lowest levels we've seen in the history of the data set. Very rare that you would get that many bears and that big of a spread bears over bulls. So a bit of an alleviation this week on that very bearish sentiment, but not enough to turn bullish by any stretch of the imagination. I put a video on my YouTube channel last week, particularly on the sentiment indicator. My channel is called Market Misbehavior. I would check that out if you want more in the weeds on the AAII survey and the history of that indicator. The NAAIM Exposure Index looks at active investment managers. It's currently at 57%, which tells you the survey of money managers that they conducted. The average allocation to equities is around 57%. So if you think of the normal allocation that this data set would suggest, in general, these money managers are underweight equities relative to their normal allocation. And again, that in general suggests that that money managers are still fairly defensive in this environment. The RIDEX flows, by the way, continuing to increase, which means the line is actually going down on this chart. I have it plotted inversely at 0.19. In general, the levels had been really, really low here in November. And so far, the highest reading, the lowest reading, the highest on this chart that we've seen was at the beginning of November. It's interesting to me that was right about just before the top. That's essentially when investors in the RIDEX funds were all in on equities, and that ended up being essentially the end of that bull market phase. Put call ratio is still fairly elevated. The total put call ratio still pretty high, and the equity only put call ratio over the range of the last couple of years as well. You have to go back to early 2020, just off the visible area of this chart, to see when the put call ratios were more elevated. And again, that has often lined up with market bottoms. However, the challenge I have is just with the VIX. Just because it's gone high a lot relative to recent history does not mean it can't go even higher. And that's one of the issues I would be looking at for that sentiment indicator. That is our segment, Getting Sentimental. We need to wrap the show. Go to the 3 in 3. Let's talk about 3 key charts that tell the story of this market in 3 minutes. Here we go. Chart number 1 is the percent of advancers and decliners, right about at 90% advancers. And 90% down days and 90% up days are a thing that many investment strategists have followed, myself included, for a number of years. There are different ways to do this based on what universe you're using. Are you looking at volume or just price movements? I tend to keep things super simple, as you probably know from watching the show for any period of time. So I'm just looking at what percent of the New York Stock Exchange traded higher today, what percent traded lower. 9% of the New York Stock Exchange closed up on the day. 90% closed down. It was a little bit higher earlier in the day. Now, before you get too excited and say, all right, that's the downside capitulation, that's the end of the move, that kind of thing works when you have a pullback within an uptrend. So if you look at pullbacks in June of 2020, September, October of 2020, those 90% down days were the big sort of puking out end of that pullback phase. But if you look back to February, March 2020, here's the problem. When the market really gets going to the downside, you'll find a cluster of 90% down days. That's the concern I would have, is that you're setting up for that sort of period. So when I hear Chris Vermeulen talking about potential for the market to move materially lower, I immediately think back to some of these breadth measures that are at pretty high levels if you look at recent bull market history. But if you look at pullbacks, if you look at corrective phases, we could just be at the beginning based on the movement that we've seen in breadth so far. Chart number 2 is looking at the equal weighted S&P versus the cap weighted S&P. This has been trending higher. And what this basically speaks to is the underperformance of the mega caps, right? If you look at Amazon and Netflix and Alphabet and Meta and these are the stocks that are really getting crushed. And that is what is certainly helping to push the major averages down. A lot of stocks are actually holding up okay. And I'm thinking of energy and consumer staples. While they're, some of them are pulling back a bit, they're still within these beautiful long-term uptrends. And while that could certainly change, what this chart is telling you is that it is paid to be away from the mega cap space and more in the smaller part of the S&P 500, more the mid cap range, which is where some of those sectors like energy are more well represented. So it's a good reminder that there is strength out there. Speaking of strength, consumer staples. In an environment like this, when the market's really getting challenged, you have a couple of options. You can raise cash, meaning you just get out of the equity markets and, fetal position, wait for things to get better. That is certainly one option. You can get into higher yielding investments and just try to generate income from the dividend component and hope that it doesn't get so bad that companies start cutting their dividend. But you can also, and I would argue the best thing to do besides those two, is to focus on charts where the relative strength is improving. This is how you outperform a benchmark in free fall. Constellation Brands is one example of that type of chart. Folks, that's our show. Special thank you to Chris Vermeulen from thetechnicaltraders.com, joining us from Toronto. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.